It started. I'm your host, Steve Van Metre, and thanks for joining me today. And no sooner than Wall Street investors were stunned by the election result, it's time to put the midterms behind us because it's now all about the Fed. Let's over to Deutsche Bank, where he picked today's story up as they note that midterms and markets, well, look pretty positive. For today, I pulled from a file from the vaults that may Excel date stamp that suggests I last used 12 years ago. It shows the performance of the S&P 500 through four-year election cycle, with year one, Q1, referring to the inauguration quarter of my new president, and midterms being year two, Q4. As you can see, 3 quarters from the midterms onward are historically amongst the strongest quarters, however far you go back. Indeed, since 1949, they are the strongest 3. And we think about why this is. Why does Wall Street get so excited about the midterms and the period after that? Is because at this point, they already know what a president's agenda is. And in this case, we know what President Biden wants to do. And we look at the midterms, and what generally starts to happen here is you see kind of gridlock start to show up. Voters kind of decide to put the brakes on things. In this case, we're looking and expecting at least the Republicans to take the House, which means there will be gridlock for the next 2 years. And there's something that Wall Street really loves is when the government doesn't get much done. And in this case, they're going to get pretty excited about that. We can look back in history and say there's a reason why post midterms, the markets boom. And here we can see in that chart, according to Deutsche Bank, that we are here, notably the 3 strongest quarters in the front of the windshield, no longer looking backwards. And however, we've also recently said that we think markets will be lower next year and that the usual midterm pattern ultimately won't repeat. So what makes us want to defy history? Well, it shows the same year 4 presidential cycle yesterday, but instead of equity returns, we show the percentage of time in each quarter since 1949 that the U.S. economy has been in a recession. For example, year 1 Q1 has seen a recession in just over 15% of the time over the last 73 years. The real jaw dropper, though, is over this period, a recession has not started in year 3 of the election cycle. So you start to think about, well, wait a minute, here we are in that year 3. Why isn't there a recession? Well, in a moment, we'll find out, because it starts to make a lot of sense why historically we haven't seen it, but why this time we might actually see one. There have been legacy recessions that ended in year 3 Q1, but for the other year 3 quarters, the graph shows a stunning 0%. Given that equities tend to bottom on average midway through recession, you can see history would suggest year 3 of the presidential cycle has always had a clear run in a way no other year has. The next question is whether there is a reason why year 3 has not seen recessions to start since 1949. At a push, an incumbent president might be more minded to allow recession in year 1 or 2 of the presidency to save bullets for the re-election campaign legacy in year 4. And that starts to make a lot of sense here of why we see this kind of push in year 3 as the market tries to front run further stimulus or spending by the government led by the president in order to get reelected. But this time, that might be different, because when did we see all this spending? Well, we saw it at the beginning of Biden's presidency, so we may not now see it toward the end. Therefore, recession risk might be front-loaded in an election cycle. However, it could also be completely random. I'll argue that perhaps it's not. If the argument on lack of front-end stimulus above has any grounding, you can't say it about this presidential cycle, as Biden saw the accumulation of the largest stimulus packages seen in history, with no bullets left to fire now, and highly unlikely if indeed the Republicans do take the House. So much so that the hiking cycle this year has been by far the most aggressive seen in any year 2 of the cycle. And we know that eventually, when the Fed gets too hot with their hiking cycle, it does lead to recession. That doesn't mean we can't see a big bear market rally before a downturn. It just means that inevitably the Fed is going to blow the markets up. As such, this time can be a lot different to history. So in conclusion, the midterms and subsequent positive equity performance charts that you're seeing from me and others have to be put in context. He said, unless, of course, you think the lack of a year 3 recession has some merit. course, send your information, he says to him at Deutsche Bank, because he'd like to know, because the reality is it's not about the election anymore. It's about the Fed. That's why the markets are reacting now, because it was always about the Fed. Let's head over now to Bloomberg, where we continue today's story. U.S. inflation slows more than forecast, gives the Fed downshift room, and that's the key point. It's the fact that not that the Fed is going to keep hiking, that they're going to actually potentially stop now thanks to a decelerating CPI. The consumer price index was up 7.7% a year earlier, the smallest annual advance since the start of the year, and down from 8.2% in September. Core prices, which exclude the volatile food and energy, are regarded a better underlying indicator, advanced 6.3%, pulling back from a 40-year high in the prior month. And so this is what the market really wants. And we look back at prior, early stage bear markets, and you can see a surge in stock prices as interest rates start to come down, or at least the expectation they come down, because the Fed's going to pause. Doesn't mean a recession's off the table. It just means this is what the market really cares about, not so much the outcome of the election. The core consumer price index increased 0.3% from the prior month, while the overall CPI advanced 0.4%, both slowing the rate of increase. Both increases as well as the monthly rises were below the median forecast, which means experts, well, they got it wrong. While the deceleration in core prices is welcome news, inflation remains much too high for the comfort of the Fed. Fed Chair Jerome Powell, who said earlier this month that officials need to see a consistent pattern of weaker monthly inflation, also indicated interest rates will likely peak higher than policymakers previously envisioned, but the market now is suggesting that that's not likely the case, because now we can go back in history and we can note that when we start to see a deceleration in the CPI, that this point is where you see the Fed pause. The market's not buying a complete pause yet, but just the fact that the Fed could slow their path is huge for investors. And here you can see the consumer price index in blue against the federal funds rate. A chart we've looked at many times. We can notably see that the funds rate starts to peak as inflation starts to flatten, or even worse, starts to come down. And here we can note that inflation is starting to decelerate, suggesting that the Fed will have cause to pause. And of course, we also want to add that there's another CPI print between now and the December meeting. So there could be further evidence to give the reason for the Fed to slow their game down. But we have some other evidence that even the bond market had this wrong, as investors were dumping bonds at record pace because they didn't believe that inflation was slowing down. Here you can see the consumer price index overlaid against the 30-year Treasury yield on a year-over-year rate of change. And we note the nice relationship between the two. Investors driving rates up, thinking inflation going higher, inflation starting to head lower, suggesting that rates could come crashing down ahead of the Fed. And that would be consistent with a bear steepener in the yield curve, which now will take the CPI and overlay the 210s yield curve, shown that in red. And it has predicted every time with great accuracy either a peak in the CPI or that the CPI is about to have one last blow-off move. Here you can see going back to 1980s, you see it called the peak in the CPI. We see in the 1990s, it's the CPI started to flatten out with one transitory peak before it came crashing down. You see in 2000, it nailed it. You see back in 2005, it got the peak there before we had that last burst of oil price shooting the CPI up in the great financial crisis. And we saw it again back in late 2018. And now again, the steepest biggest inversion since 1980s, nailed the peak in the CPI here. And all it's suggesting is that Powell is more likely to actually scale back his plans as we see the CPI continue to decelerate. And when we look into the data, what do we know? That, of course, used cars and trucks are now starting to head lower, and that, as we talked about in yesterday's show, is likely to further accelerate. Apparel prices coming down. How about medical care? That's coming down. We note even pipe gas service due to that flood of gas hitting the markets is now coming down, suggesting that we're going to likely see continuation in that deceleration in the months to come. And for Fed officials, they will have both, as I said, another CPI report and a jobs report in hand before the end of their two-day policy meeting that comes in mid-December, again adding to the narrative that perhaps, again, we could see the Fed even slow their rate, and the market says, yeah, we've got that priced in. Today, after the CPI report, we note that prior, the FOMC odds of a 75 basis point hike now went to 0 and 100% odds of 50 basis points, and that number could go down, creating a tailwind for not only the stock market, but the bond market as well. And one thing that's also going to factor in is the much delayed owner equivalent rent of the CPI. This is a very lagged part of the CPI index that tries to estimate what rents are. And this number, as Jeff Snyder and I have talked about on his show, is set to fall dramatically in the coming months, is likely to stay elevated before it too rolls over. So we could see in the early parts of next year, the CPI come crashing down, putting the Fed at a point where they're now in reversal mode compared to where they're headed now. Meantime, elevated inflation continues to weigh on American households and the broader economy as high prices have eaten away at wage gains and led many to either tighten their belts or rely on savings and credit cards to keep spending. And this is a hot button for the Fed. They want to bring inflation down because they believe the job market is strong enough that wages will stay up, that people won't lose their jobs, and that everything will work out. And there's a sense of urgency because, as we note on this chart from Zero Hedge, that U.S. real or inflation adjusted average weekly earnings remain negative, and that means the CPI is running much hotter than wages. You can bring CPI down, wages stay where they're at, or even tick a little higher. This puts a tailwind again behind the economy and gets the Fed out of their dire situation. Of course, we know the real way out of this is they're going to crash everything, but for the moment, at least investors may look for that Santa rally and over the next couple of quarters before the data catches up. But all eyes now are on the Fed, and that's what matters. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.